Good morning and welcome this morning to Trading Futures, another great webcast from Schwab. My name is Ben Watson. There's the opening bell, and that means we're off and running. Of course, the futures markets have been off and running for a little bit here as we come back from a long weekend and into a holiday shortened week. And we're going to get into that discussion here really quickly. I'm joined out there in the chat by my good friend Brent Morse, 20 plus year veteran in the financial markets, great friend and a great educator. And he's there to help answer your questions along the way. And of course, all of you are here with me. Whether you're here for the first time or the 100th time, I appreciate you being here. I'm grateful that you are there watching this. And if you're watching this on the recorded version, thank you for being here as well and doing this on your own time. Make sure that you leave some comments for us in the comment section. For those of you that are here with us live, participate in the chat. We're going to talk really quickly about a couple of things this morning. One of the things that oftentimes happens after a long holiday weekend is gasoline prices drop. So we're going to look at that right off the bat. And we're going to also take a look at what's going on in the silver market and perhaps a little bit of what's going on with volatility. So let's do that. Let's jump in here this morning. A couple of quick housekeeping items. Remember that everything you talk about is simply for illustrative and educational purposes only. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to trading any futures products. Remember that futures trading requires separate authorization, and make sure that you are aware of those risks. There are resources available for you to be able to identify and understand those risks. So take advantage of those resources. And as we get into this discussion, a couple of quick specific notes. Remember that anything that we discussed today that talks about things like technical analysis, probability analysis, fundamental analysis, those are all theoretical in nature. They are not guaranteed. And in fact, Schwab doesn't recommend the use of technical analysis as the sole means of investment research. Now, if we do happen to look at virtual currency derivatives and futures products this morning, remember that they involve unique and significant risks. Make sure that you read the NFA investor advisory on futures on virtual currencies, including Bitcoin, and the CFTC customer advisory on the same area, same topic, before considering any of those strategies. And if we do happen to look at those, you've been warned. Now, that being said, we're going to be using the Thinkorswim desktop software platform here this morning, specifically the paper money version. Paper money version is a great way to practice. It does not do some things that the live trading account will do, things like fill prices, things like studies in scans. So just be aware of that as you move your practice from paper trading to live trading. Also, the last thing I want to talk about really quickly, and we'll get into this as we get into some specific examples, is just remember that stop orders behave a little bit differently with futures products than they do with equities products. Stop orders that generate a market order in a futures product will be it's substituted for an exchange designated limit order within a protection range or based on protection points. That is for protection against fast moving markets. So there is the potential that that order gets rejected or not filled. And that is a result of that movement outside that protection range. So just be aware of that fact. Stop limit orders will function as a stop limit order simply because that limit order defines that range. That said, remember that limit orders can be gapped around, especially in a fast-moving market. So make sure that you're aware of those characteristics and risks of stop orders when placing those in the futures product. So let's jump in here really quickly. We're going to talk about some futures, specifically the aspects of those futures contracts, and we're going to look at some example trades. So I'm going to pop over here to the Thinkorswim desktop software platform. We're going to get right into this mix. Good opportunity for me to click on, ask you to click on that subscribe button down at the bottom of the page. It's a free subscription, doesn't cost you anything, but it helps you and it helps others in that context of bringing this content to you. So click on that subscribe button if you haven't done so already. Let's take a look at /RB. This is the gasoline contract. And one of the things that is almost inevitable, not inevitable because sometimes it doesn't happen, but more often than not in the time that I've been alive, typically gasoline prices go up into Memorial Day weekend and they go down following Memorial Day weekend. Now, how far down they go remains to be seen, because it is the start of the summer driving season, and theoretically there was more driving activity going on this weekend than there has been in several years. And we can see what the price of RB gasoline /RB gasoline has been doing, the RBOB, and it had been moving up as we get into April and May, starting to pull back over the course of the last couple of days. And in fact, in the 5-day, 5-minute chart, we've seen some pretty good downward pressure. In fact, the MACD kind of coming back down. So I drew this horizontal support line kind of right across this area here at the 2.09, 2.1, right about 2.1 level. Just a little bit below that, and you can kind of see where that resistance area is here. My thought being, in this particular case, if we are seeing continuing downward pressure in /RB, we've got an OPEC meeting coming up this week, but the typical nature of supply and demand is that demand is going to fall off for a little bit after a big holiday driving weekend like Memorial Day. So looking at taking advantage of that potential, maybe down to the diagonal trend line here. If this is an upward channel, maybe at least down to this diagonal trend line, or maybe seeing it come all the way back down into this horizontal support area down around the 1.94 range. That would be a pretty good move to the downside. But in the meantime, we're going to look at maybe making an effort to take advantage of this move in a pretty quick level. So I'm going to kind of find my diagonal here at about the 2.04 level. And that's going to be my target to the downside in this particular case, is down to that 2.04, that downward move. So this may not be just a quick hit type trade. We may be in this trade for a little bit. That being said, I'm going to manage risk in this trade from the standpoint. Remember that there is the potential for this to move up, potential for it to move down, and move very quickly. This is a relatively volatile contract, as you can see. You know, you can see some of these big moves that gasoline has made in previous days. So looking for this to make that move to the downside. So where I'm going to try to manage the risk in this particular case, or in other words, put a stop order. Now, granted, remember, those stop orders, depending on how they're selected and how they're put in place, can be gapped around. So, you know, again, properly warned ye be, right? So I'm going to draw in a line here right around this 2.11 mark. That's going to be my definition of where I'm going to look at this trade. But recognize that it could blow through that. So it's not a set it and forget it trade. No futures trade, nor really any trade, should be considered to be a set it and forget it type of trade. But that's where I'm going to exit the trade. We're going to look to get in on this continued move to the downside. Now it's starting to bleed back up above this horizontal line here. So I'm going to use that as kind of my trigger line in the sand to get into the trade, right? Because this is starting to push back just a little bit to the upside. So I really want this move to the downside at the 2.09 level. Maybe not 2.09 even, but we're going to go to 2.096. Let's see what our contract specs are in this particular case. So I'm going to open up this left-hand side. Our tick size is 0.0001, right? So this is the significant digit that we're looking for, right? That significant digit moving represents a $4.20 move in the value of the contract, right? So this moves from 2.0994 to 2.0995. That's going to be a $4.20 move in the value of the contract, right? So each point that this moves in this particular case from 2 to 3 is $42,000. The notional value of this contract is relatively large, but if we pop the drop down here and we go to our futures and we find /RB, we can see that our initial margin on this particular contract, because this is a very liquid contract, is not enormous, but it's not the notional value for sure. I mean, that's, you know, one of the leverage factors of trading futures contracts is that initial margin, which will then become the maintenance margin once the position is initiated, is smaller than the notional value, controlling more with less. That's leverage, right? So as we pop into this, I'm going to set my entry at this 2.097 level. So we're going to right click and I'm going to create an order that is a sell custom because we're going to short the futures contract here in this particular case, take it to the downside, sell that custom with OCO bracket. Now we've got our charts up here. We've got our order that we're going to put in place, and we'll go through this and then we'll talk about it a little bit more. I don't want to talk through the trade here because I'm afraid that that's what sometimes we've done. So my trigger to get into the trade is going to be at the 2.097, and we'll do it at 2.097 even. Actually, we go to 7.1. Let's go to 2.097.1, and that's going to be our entry. So we're going to do this. We're going to make this a sell stop, right? And this sell stop, again, because it's going to issue a market order, is going to be worked as a exchange designated limit order, even on this entry into the trade. We're going to leave that as a day order because I don't want to hold this beyond this one day. My stop orders, or my take profit and my stop orders, I'm going to make those good till canceled so that I don't have to come back and recreate those on a regular basis. So let's make our stop in this particular case. The move here to the upside, right? So we're going to say, right, fine, this is going to be our buy stop. We're going to wait till it gets to, in this particular case, we'll go to 2.1118. We're going to make that our buy stop. And again, that's going to be 2.1118, because remember, we're selling the contract, so we're expecting the contract price to go down to take advantage of that downward movement or that downward propensity in the RBOB contract here. And we're going to make that good till cancel. Now it's going to give us an interim note here that says the orders in the same OCO group must have the same time in force. So that means we're going to have to change this order to get out if it goes down to that same time in force, to good till canceled. So now we've got our stop order in place here at 2.11118. That's going to be worked as an exchange designated limit order unless we put it in as a stop limit order. But nevertheless, either case, that could be gapped around and not filled. That is one of those potential risks. So again, it's perhaps also, being belt and suspenders, we might put an alert on that as well if you were concerned about that possibility, to look at manually adjusting that trade and taking it off. So what we're going to do now is we're going to come back over to our chart here, and we put that at we went to 2.05 to the downside here, right? 2.05, and we'll make that stop to the downside 2.05. Right, 2.05. And this is the point at which we would look at taking this position off if it moves in the direction that we want it to move. So moving from 2.09 to 2.05, that's going to get us our potential target here to the downside. Now, really quickly, before we file this order and send this off, what I want to do is I want to kind of give you a perspective on what that trade looks like, risk to reward standpoint. So I'm going to kind of squish this a little bit. I'm going to go to my 2.05 level here, and I'm going to draw a line. So visually, this is always a good idea if you're ever, kind of considering or wondering what that trade is doing and what the expectation is, and is the juice potentially worth the squeeze from this standpoint. Here's the risk potentially if it goes against us. Here's the potential return if it does go in our favor. And again, those are not guaranteed. I'm not being hypothetical about what those prices are here in this particular case. I'm just looking at the ratio here, kind of the relationship, and saying, yeah, I stand to make in this particular trade, if it moves in the direction that I want it to go, potentially more, and about 2 or 3 times more than I stand to lose in this particular trade, right? So we're going to go ahead. Let me kill my annotation here, and we'll fire this order off. We'll pop it up from down below. Once again, we've got our order entry tools down here. We're going to make sure that we're okay with that order. Click on confirm and send. We're going to read through this order. Our initial margin in this trade, and this is going to be a fairly large trade. This is the large contract. And right now, as far as I know, there is not a micro, or at least not on the Thinkorswim platform, a micro RB contract, micro gasoline contract. So we're going to go ahead and accept that initial margin of 6,034. Not that we have any choice in that matter, given the fact that it is designated by the exchange and by the broker in terms of that margin requirement. Remember, margin requirements are not static. They can change depending on volatility and depending on exchange rules and things like that. There is the possibility that those initial and maintenance margin requirements can change over time. So we're going to go ahead and we're going to click on send. We're going to fire this order off. And it hasn't filled yet because it's sitting there as a waiting condition. So when I said one of the things that we might do if we wanted to be belt and suspenders is this one right now. And it does, you're right, this contract does expire in 3 days and this will roll. We could move this to the active contract if we go to the trade tab. So that's got 3 days. This has 35 or 34 days to go in this particular case. So we can roll that contract. As you start to see this volume change, you start to see that volume changing. So we could roll it to this one. Current active is the 3 days to go contract. The RBN to 5 contract, we could change that order to that price again, right? So probability says, is the open price above the previous closing price? Oh, I think you're talking about that. Okay, there you go. You're asking Brent a question there. All right. So we don't get a fill there. We can roll that, and we'll roll that to the other contract. But you can see that what's happening here is we're starting to get a little bit of a push back to the upside in this particular case. What's important, not necessarily this specific example trade, but the circumstances that it is setting up. Let's do this really quick. Let's pop back over here to our futures grid, kind of get a sense of what's going on in the market today, because I know a number of you have been asking this question as we've been going along, is what is going on in the equity futures as we come off of this long weekend. We see that little bit of a bounce here up off of the 200 period moving average on the /ES S&P 500 futures, and that move, making that move to the upside, but coming off the high of the day at the moment. Taking a look at the NASDAQ doing the same kind of thing, well above the 200 period moving average. We almost are at an engulfing candle here in this particular case on the /NQ, but once again, it's coming off of its highs a little bit. The Russell 2000 kind of sitting there, again, a bit of a bounce after a hammer candle, but also coming off of those highs as the market starts moving, as the cash market starts moving, and things kind of start to rotate back around and balance themselves out as this market keeps moving today in this holiday shortened week. And there's some rotation and adjustment from the fact that we had a day where the futures markets, the bond market, the equities markets were all closed here in the US. So some rebalancing and kind of readjustment. Speaking of rebalancing and readjustment, one of the things that we always try to do is try to make these webcasts better for you. One of the ways that we do that is we ask for your feedback. The feedback survey that just popped up in the chat, Brent's going to pin up to the top of the chat. And so you can have a chance to be participatory in this webcast beyond just asking questions. You can be participatory by filling out that feedback survey, and you can click on it now and set it aside. You can click on it now and fill it out. You can click on it or wait to click on it until the end of the webcast when you've decided whether or not you like it, whatever you want to do, or you have further comments. But any way you think about it, any way you click on it, do it so that you can help us out to make these webcasts better for you and for other people as well. We read those comments and we take advantage of your comments to make these webcasts hopefully better for you. Now, the other thing I wanted to look at here really quickly is what's going on in volatility. So I'm going to go to the /VX, and we're going to take a look at this in the longer term chart here. And one of the things that we're seeing with those equity markets being up a little bit is that volatility kind of coming down just a little bit. The VIX coming down. We saw it kind of break down or break above on Friday, going into the long weekend, and then coming back down a little bit. When volatility spikes, it typically tends to move lower. The mean average for volatility over the course of the last 10 or 15 years has been right around the 18 handle. We're currently sitting at about 20, barring any potential news, and we're a week or so away from the Fed meeting, a little bit more than a week away from the Fed meeting. We had Jay Powell speaking over the weekend at Princeton at the commencement exercises. That tended to perhaps calm markets a little bit. We have tariff news that is calming markets a little bit. So VIX is coming down just a little bit. If we zoom in here, we can see that VIX futures contract, this isn't the VIX index, this is the futures contract. So this trades sometimes at a premium to, or sometimes at a discount to, what that VIX number is showing. So you're not going to see an exact correlation between those two. But that being said, starting to see a little bit of a push to the downside in the volatility contract. And so let's do this. Let's pop back to our futures movers grid really quick. We're going to come down here to /VX. And once again, looking for this break to the downside with a move maybe back down into the 18 handle. So let's kind of break this open and see what our specifications are. Again, tick size is 0.05, which means that our tick value that matters is this one right here. And we're going to see that move, that tick value move. And every time that tick value moves, right, that's going to be a $50 move in the price of the contract. So a point move, so 20 to 21 is going to be $1,000. 20 to 19 is going to be $1,000, right? That's that point value move in this contract. So our notional value, 20,400. If we go to the drop down and we go to our VIX futures here, which is right here, that VIX futures drop down. Let's go to the futures drop down. There it is right there, VIX futures. Initial margin in this particular case is 10,175. So a little bit more expensive product. Now, here's the thing. As we go to /VXM, VXM in this particular, and there we go. We sold that contract, so we're in that trade. That VXM in this particular case is a smaller contract, right? And being a smaller contract, sometimes this is the mini contract, and you can see the change in the tick size and the tick value, right? So each tick size is, instead of 0.05, it's 0.01, and each tick value is $1. So each point value, so 20 to 21 is $100. Notional value is $2,040. Initial margin in this contract is 10,017. That margin is specifically lower because the contract is a tenth the size. You can see the tenth of the big contract. The problem is, if we were to show, in this particular case, open interest and volume. So if we come back down here to the trade tab, and even though this contract, this VXMM25, which is the active contract, 22 days to go until expiration, you can see the difference in volume in this particular contract. 549 contracts traded. If we were to take this to the /VX and look at the active contract, you can see the difference in volume, right? Much more significant trading volume in the larger contract. So this is the challenge, right? You trade the smaller margin, but you suffer from the liquidity. You trade the larger contract, higher initial and maintenance margin, but you have more liquidity. So 6 of one, half dozen the other, 6 to 5 and pick 'em, whatever you want to express in terms of that process. But thinking about in terms of the ease of entering and exiting positions, if the portfolio size substantiates that larger initial and maintenance margin, then the larger contract may be the more liquid of the two in that combination. So we'll go back over here to our charts and we'll close this back down. And whoops, let's restore that really quickly here, and we can start to see that that is moving to the downside. So we're going to look for this to move down to that 1802 mark, right? So in this particular case, in looking at some of these volatility products in live trading, recognizing that orders may be different, and depending on because George makes the point here, right? If we can do this in paper money we can put those stops on. In some certain circumstances, in live trading, stops are not enabled on some of the futures products, or some of the volatility futures products specifically. So how you manage that trade then becomes a function of either putting on a conditional order to exit the trade, or putting on an alert and then using the alert as a means to take that trade off, to give you a reason to go back in and exit the position, right? Both of those circumstances, right? Both a conditional order and other circumstances like an alert require action on your part, right? They require you to either create the conditional order, they require action on your part to listen to the alert and take the trade off. Now, this is starting to make that move to the downside. So what we can do is we can kind of back into this and create this order. So what I'm going to do is I'm going to manage this. So we're going to manage our risk here at this 2075 level. So I'm just going to draw that line in at 2075. Right. And I'm going to, and one of the reasons for that, and to get to that point, one of the reasons for that, especially in things like volatility product, which can move very, very quickly, is that when there is an OCO order, there is the possibility, especially, and this goes back to the liquidity discussion, when there's a lack of liquidity, if that order does not fill on one side, there's a possibility that it could trigger that order, and then the market could move quickly to the other side and trigger the other opposite order before the other one has cleared or filled or canceled. So you could be in a situation where both sides of that OCO bracket order end up filling. So what we're going to do is we're going to create two orders here from that standpoint. And we're going to do one as an alert and one as a conditional order, just so that we can see how we can do both sides of this trade. So my exit's going to be up here at 2075. My move to the downside, I'm going to look for this to move. We're maybe not going to come all the way down to that 18 flat area, but we might come back down into this area where this has made that move. So I'm going to go to about 1955 in this particular case as my target. We'll go to 1950 in this case as the target. We'll make 1950 the target. I'm going to use the larger contract here simply from a liquidity standpoint. And you can kind of see, once again, that ratio of where we're going to get out versus where we're going to get out to the downside, or where our conditional order theoretically would get us out to that downside. So here's the thing. We're going to right click and we're going to enter this short position on this contract to the downside. So we're just going to come down here and we're going to sell that single contract, and we'll bring this back up here. We'll make sure that we're aware of that. Again, there's our initial margin in the trade. That's our buying power effect. And we're going to fire that order off. Now, that order is going to, right, we're now in the trade. We are now short the position. So what I'm going to do is I'm going to use the conditional order on top, and I'm going to use the alert down here on the bottom. And the reason I'm doing that is, if this keeps going lower than 19 and I'm short the position, I'm not really worried about that. That's less of a concern to me if I don't happen to get to that alert right away than if this goes against the direction that I want it to go. So I'm going to come down here. I'm going to create an alert at that level, and it's going to be the same process, right? So if the mark is at, or in this case, below, okay, and we're going to use this. Here's our contract. We're going to use that level, 1955. Notify with a sound, send me a text, all of those things, and click on create. And there's my alert to get out of the trade. And you notice that it kind of came back just a little bit against that 1950 even, so that that alert triggers. If it starts to go down, we get a little bit closer to that level. So if this keeps moving to the downside, I'm okay with that, as long as I'm able to take the trade off before it reverses, because it can reverse. And remember, VIX is a product that can move very, very quickly. Again, it's a volatility product, so we need to be aware of that. So now I'm going to come back up here to this 2075. So I'm going to go back to my monitor tab, and we're going to see, since we're already in this position, here's our RB position, and here's our VIX position that we're in, short that contract. So what I'm going to do is I'm going to right click and I'm going to create a closing order. And that closing order would be to buy this back, but we're going to use this as a conditional order. So I'm going to come over to the little gear icon. So I'm in my order entry tools, and you see the little gear icon over here on the left-hand side. Excuse me, right-hand side, all the way over on the right-hand side. And I'm going to click on that gear icon. And now what I've got is this order rules box that comes up. Let me kind of shrink this for us a little bit so that we can see it, right? So this is my order rules box, and this would be the order to buy this contract back if it does what I don't want it to do, right? Which was to go back to the upside. So I need to make sure where that is going to be. So I'm going to close that down again, and we're going to go back to our chart, and we said at 2075. I just wanted to make sure that I knew where that was going to be. So we're going to pop our order up. Once again, there's our order. And we're going to make this, again, that conditional order. I'm going to bring my order rules box up. It just drops to my second monitor just because the way my monitors are arranged here. So I'm going to shrink this so that you can see it. If you have multiple monitors, this might be a challenge for you sometimes if you see one of these order boxes or these dialog boxes that pops up. That then becomes a challenge to get the order filled. And you may have a dialog box that's off the side of the screen. That's happened to me before a couple of times. So we're going to make this, in this particular case, we know that if we were to put this in as a stop limit order, we can specify that limit price, right? And we're going to say, all right, if this gets to 2075, right? This is going to be a buy stop limit. So 2075, and we'll go 2078 as our buy stop limit. I'm not sure what we would have to go to the exchange to see what the protection range is for an exchange designated limit order, but I think we're probably pretty close. It's generally about 10% one side or the other, or either side, for those exchange designated limit orders. We're going to make this a good till canceled so that that order is in place. Now, this is not tied to anything. So this is not a GTC. If this order goes up and gets triggered, it's going to fill that, or that alert will still be in place. And that's why I'm doing this as an alert and a conditional order, so that I'm not creating that GTC, so that I don't have that possibility of getting slammed on both sides, right? And we're going to make sure that this is what I want. We're going to go ahead and click on save. Now that conditional in is 5. Okay, so we got to do this, right? Let's see. There we go. Minimum price increment is 0.05. Oh, I see what it is. Okay, so yeah, my limit is too close. So let's go here. There we go. And specify that. There we go. And because I had the wrong decimal in there, because I let it float based on the price. And we're going to go ahead and we're going to click on confirm and send. So always a good idea. Again, remember to read the order. Make sure that you're aware of the alerts that pop up. And we're going to put that order in place. And we're going to put that in our futures group. And we're going to click on send. And now that order is going to sit there as an exit, right? If this goes opposite us. This one requires us to do something. This order up here at our exit point doesn't, but it's not going to close this alert or get rid of that alert. So, but the fact is that that alert is there. We still have to do something. That still requires us to take action in this particular case. And that is one of the concerns when you don't have an order in place to actually do that, right? So VIX is moving the direction we want it to do. We can see that move to the downside. We're short that contract. We go back to our monitor tab and we can see that that's starting to move in the direction that we want it to do. So is our RBOB trade, gasoline moving to the downside here a little bit. So we're starting to get that initial move to the downside. Now, the other product that I was looking at this morning that was moving was silver. So let's do this. Let's come back to our charts. And somebody had asked about this label right here. So I'm going to go back and we're going to maximize this cell. This label is a scripted label, and I've put this script out there in the chat before. It's also it's saved in the description for this particular webcast. But what I'm going to do right now is I'll click on that script. You can see what that script does. I'm going to go ahead and share this. Now, remember, anytime we share these scripts or studies, custom scans, watch lists, chart grids, anything else, those are for illustrative and educational purposes only. They are not guaranteed as to time or accuracy. And we've got some great short videos that talk about how you can apply those shared items to your charts if you want to, right? But that's how you see it. And let's come back. We'll restore our cells here. And I want to go to /SIL. This is the 1,000-ounce contract. The big contract is SI. The small contract is SIL. We're going to look at the small contract here in this particular case. So my thought was, and again, if we go back here to our futures dropdown in the symbol entry box, here's the large contract. We can see that our tick size is 0.005, tick value is 25, and the initial margin is 16,000. The small contract is 0.005 tick size, $5 tick value, initial margin 3,300. So different notional values, different size components, different tick values in these two contracts. So in the interest of keeping that initial margin cost lower or impact lower, we're going to go with the /SIL, the small contract. If we go to the trade tab, we can see that this is a contract, and here's the active contract, 33 days to go until expiration. The small contract here, the 1,000-ounce contract, different notional value, different size, has a fair amount of volume. If we go to /SI, the big contract, we can see that, yeah, there's quite a bit more volume in the active contract, but you know, the difference between 16,000 contracts traded versus 45,000 contracts traded, they're both liquid products. We're not talking about the difference between 450 versus, you know, 20,000 like we were on the VIX contracts, right? So /SIL, and here's our contract right there. We'll go to the chart. And my thought process was here, we've got this breakout of this diagonal up downtrend line. And we're kind of on the cusp of this little bit of a flag type of pattern in silver. And the other thing I was seeing here is that our commodity channel index, which is our indicator in the lower left-hand side of this grid, was starting to stay kind of well up in that pretty strong trend range. So it's establishing this fairly strong trend. We saw some moves to the upside in these overnight candles and starting to make that move higher. Momentum, because I've got the MACD over here on the right-hand side, was moving higher as well. It's come back down. And what I'm going to do is I'm going to switch specifically to this one. This is my 5-day, 5-minute chart. And I'm starting to see this little bit of a bounce. And in fact, an engulfing candle on this last 5-minute candle. So my thought process in entering this particular trade would be a break above the 33.21 level and a move maybe back up to, out of this range, up to maybe that 33 where this previous high is here in this particular case. So fairly short-term move, again, up to 33.69. So we're looking for this to be, or 33.70 right about there, to be the target to the upside. And we're looking for the exit in this particular case would be a break below this diagonal downward channel at this 32.91 level. So you can kind of see the circumstances of the trade. And again, you can kind of see the range. If we get in here, that's a little bit more than 1-to-1, not quite 2-to-1 here in this particular case. But that would be the circumstances of the trade. So what we're going to do is we're going to right click and we're going to buy custom with OCO bracket once again. So our buy stop trigger in this particular case, because we're going long, is at the 33.20 level. We'll make that 33.20. And we're going to leave that as good till canceled. So we're currently trading at 33.19, so we're pretty close. I'm probably going to talk through this trade, but we'll see what we do. And then to the upside, the take profit is going to be at 33.70. We'll make that pretty easy. So we're going to sell this if we get to 33.70. And this is going to be a fairly quick trade theoretically, but we're going to make it good till canceled. We're going to make this one good till canceled. And we're going to exit if this goes against us to 32.92. So 32.92 to the downside is going to be our exit. So we're at 33.20 right now. So theoretically, this is at our 33.19. 33.20 is going to be our buy stop limit in this particular case. Oh, no, we need to make that a stop, right? So reading the order helps, because I was going to put that out there as a limit order, which would mean that it would fill immediately. In this particular case, we're going to stop and wait until this gets to 33.20, which it's done. Now that limit circumstance or that trigger circumstance has been met, and this will issue a market order. That'll be worked by the exchange as an exchange designated limit order within those protection points. And we're going to go ahead and click on confirm and send. And we're going to make sure that this is what we want. There's our initial margin in this trade. We're going to put this in our futures account, our futures group in this particular case. We're going to go ahead and click on send that order off. We got in at 33.22. Now looking for this move to the upside. The reason for the buy stop here was if this is a bull flat, right? If this is a breakout of that resistance level, then that's going to be concrete evidence of breaking that resistance. We had confirmation of breaking this diagonal downtrend line, right? Now looking for continuing move to the upside. We can start to see some building momentum here to the upside, looking for this continuing to make that move to the upside. Now, it might not do it today in this particular case, because if we look at our grid, where is that level right here? 33.70. Let's put that on the chart here. 33.70 is going to be right up about the top of this pattern right here, right? We can see where that line is. That's about where that line becomes that resistance level. So that's kind of the move that we're looking for in this particular case. Listen, if you want to learn more about trading futures, one of the ways to do that is to come right over here to the Trader Talks webcast page and type in the words futures. And you're going to see Brent and Michael Fairborn and myself talking about trading futures, James Boyd talking about trading futures, James Boyd's Futures 101, and how does that fit in for somebody who's just trading stocks and options up to this point? How do you learn about trading futures? The other thing that I would encourage you to do, if you want to learn more about this, is come and join us for one of our in-person events, specifically our Advanced Option Strategies workshop. Now, the one that we've got coming up this weekend that I will be traveling day after tomorrow to in Anaheim. We do have a segment of introduction to futures. We have some sponsors from third-party providers, CME and others, that talk about futures and futures products. This one happens to be full, although there oftentimes becomes room, but the registration right now is full for that one. The next Advanced Options coming up is going to be down here. And I know we've got a couple in the middle of this December in Miami, but this is a great way, if you like to join us live, to learn more about these activities and more about these different products. So hopefully you can come and join us at one of our live events or one of our webcasts. We would certainly appreciate you being with us. My thanks to Brent Morris for helping out today. to our great production staff, and to our great reviewers, Mindy and Nikki and everybody else who helps to bring these webcasts to you. They do a great job. They work very, very hard behind the scenes. Do me a favor, click on that feedback survey, fill out that feedback survey, click on the like button if you like that, if you want appreciation to our production staff and to everybody else. Thanks, guys. We'll see you guys here later on for our full slate of webcasts throughout the day. Take care, everybody. Bye-bye.